and welcome to this week's episode of Coinscrum Markets. I'm Teana Baker-Taylor. Coming up, James Bennett returns to review this week's Onchain data and Onchain reaction. I speak with Arcane Crypto's Eva Laurenz and Blockwall's Lawrence Apiarius to see what's catching the attention of blockchain's VCs right now. And Trustology's Alex Batlin is joined by Aave founder Stani Kulichov and James Kilroe from Tendex to discuss money markets on DeFi. First up, on-chain reaction.
Hello and welcome back to On-Chain Reaction, and what an exciting week it has been. I'm your host, James Bennett, and I'm the CEO of ByteTree, where we provide on-chain data and asset management services for digital asset investors. Okay, so let's jump right into it. So Bitcoin remains in a lower volatility regime despite the recent price surge up towards $19,000, pushing $20,000 as of today, the 25th of November. We can see that in previous bull markets, here just looking at 17, Bitcoin's price volatility surged up to around 150% on an annual basis, whereas at the moment we still remain around the 50% mark, which is lower than the likes of Amazon and Apple stocks and certainly Tesla stocks over the last few months. So very exciting to see Bitcoin price surging up to new all-time high levels with volatility still remaining low. Diving into the metrics on-chain, we can see that Bitcoin's transaction value has held well above the $5 billion per day mark. So that means that there are over $5 billion worth of transactions being settled on the Bitcoin network each day. You can see highlighted by the gold circles those periods where it's happened in the past. Again, in the past, prior to a subsequent drop in price, indicating that we were in a late stage of a bull market, a bit of a frenzy as whale money was moving around the ecosystem perhaps. Here, we're starting to see a more sustainable picture building up, and I very much look forward to seeing this progress over the coming weeks and months. So, looking at it from another angle, the on-chain transaction value we look at ByteTree across the whole spectrum. So, we look at the small transactions, we call them micro transactions, all the way up to the whales. And one of the things that we like to do in order to understand the type of users on the network is to break it into quintiles. So that's 5 different bands going from the smallest to the top band, each with an even number of transactions in it. So say we had 2,000 transactions going through a block, then divide that by 5, you get 400. So then we're looking at the value here in the bottom quintile of the first 500 or lowest 400 transactions and what they amount to. What this allows us to see is, okay, the lowest value of traffic, that bottom quintile, is actually growing in terms of its value, which means that we have a slightly more sophisticated sort of user on the network, which is transferring a higher value as a standard payment. As we can see, the last time we were up at these levels was in the bull market of late 2017. You can see in the dark blue lines along the bottom. And again in July 19, similar kind of story. But here on the right-hand side of the graph, we've really seen an organic build in that traffic that isn't sort of reflecting those previous very spiky movements that we saw. Which gives me confidence that this is sort of a well-sustained or underpinned bull market. Okay, as you've seen each week, we like to look at the miners' position. Miners are an integral part of the Bitcoin ecosystem. We need them for Bitcoin to continue running. Miners are doing very well, I'm pleased to report. Their revenues are the highest they've been so far in 2020, despite the halving event that we saw in May. So we're seeing at around $20 million plus of fees, of total revenues. That's fees plus Coinbase, so newly minted coins being generated, and that's just really positive to see. And fees that had spiked at 28% of those revenues have now returned to a more sort of normal level of 10%. Still, that is reflective of a bull market, but it isn't this sort of overpricing that might cause people to start seeking to use another network in place of Bitcoin. Okay, the final chart here, we're looking at the miners rolling inventory. Quick reminder, that is the difference between what has been mined and what has been sent out for the first time or spent for the first time. Each time a new Bitcoin is generated, it's essentially flagged as a new coin, and we at ByteTree track when that has moved out of that inventory wallet. We can see that miners sold very strongly into the current price surge, peaking out at 123%. So they were taking their opportunity to bag profits while they could. You can see MRI has now dropped down to about 106%, so that means they are actually still burning off inventory, excess inventory. Of course, if they're over 100%, they're sending out more than they've generated, which is only possible if they were sitting on an inventory from before. So overall, all lights are green for the Bitcoin network at the moment. A terribly exciting time to be involved in the market, and we look forward to speaking with you in a couple of weeks. Stay safe.
One of the dynamics that has enabled early blockchain-focused companies and networks to grow was the ability for early Bitcoin and Ethereum hodlers to divest and seed a swath of projects within the ecosystem. With venture capital firms dedicated to the industry rapidly following in, and the next wave of adoption and innovation upon us, I spoke with Eva Laurenz, Chief Operating Officer at Arcane Crypto, and Laurenz Apiarius, Managing Partner at Blockwall, to find out how they're looking to position themselves. I'm delighted today to be joined by Eva Laurenz, Chief Operating Officer at Arcane Crypto. Hi there, Eva.
Hi.
Hi. And Laurenz Apiarius, Managing Partner from Blockwall.
Hi.
Laurenz, thanks for joining us. And we're going to be talking a little bit today about crypto venture capital and what the landscape looks like. So, over the past year in particular, we've seen the labor born out of the 2017 bubble come to fruition, with ever more blockchain venture funds entering the market. So let's learn a little bit about your firm. So to kick things off, could each of you tell us a little bit about yourselves and your companies and how those companies came about? So Eva, let's kick off with you.
Sure. So I started life as a lawyer, specializing in funds and financial services. And then I worked in-house at Morgan Stanley for about 8.5 years, both in legal roles and trading, and ended up heading up their securities lending team out of London. Mm-hmm. And then I've been consulting for a couple of Arcane's portfolio companies at the beginning of the year, and then actually moved over to the COO role within Arcane itself in August. And so Arcane Crypto was set up by two serial investors and entrepreneurs in Norway who saw this opportunity to access the crypto markets from the Nordics and set up their own crypto-focused investment company. So they brought in Torbjørn Bull Jensen, who is one of the best known, or if not the best known, Bitcoin and blockchain expert, to help them. And we're most recently about to be listed on the Swedish Stock Exchange.
Congrats. Laurenz, how about you and Blockwall?
So I guess part of what's relevant to that is a bit of my origin story, since I grew up as a son of an entrepreneur who has been a son of an entrepreneur. So this was my daily breed and to see and live that. But essentially, after business studies, I went into work with my father on various businesses that he had founded. We did that. It was a very steep learning curve. I eventually migrated to Zurich, doing private equity investments, which was also the time when I got to know Bitcoin, I think it was 2014, until 2016 when two university friends and we started Blockwall, because we saw that in particular for the German-speaking markets, there wasn't really a bridge for investors to participate in this because it was just too complicated, and infrastructures that were there were just so, they at least seemed so dodgy that it wasn't really accessible to a few. So we set up a regulated fund structure out of Germany, raised a first fund that exclusively invested in protocol tokens. And at the moment, we're setting up a second fund, complementary to the first one, that's solely investing in early stage startups that are using blockchain as a general edge in order to provide better business models.
So let's take a look at your investment thesis, both of you. So I'll pose this to each of you. Are you both making equity investments, early investments, investing in tokens? What are your current portfolio companies? What's kind of your route to market?
Sure, I briefly touched this just now. So we have funds dedicated to each strategy. So the first one it's a closed fund, still running for 3.5 more years, is exclusively focused on token investments. And the thesis behind that was that decentralized infrastructures have a merit and they have certain use cases. And within that, we've done several allocations in already liquid tokens, but mostly we've allocated into early stage non-yet liquid token protocols, both in the smart contract space, data marketplaces, and also Bitcoin. Also with the long-term goal, this is something that is of value and that is to be monetized. And the learning curve of the past years has been to not play the liquid part, but to really have that long-term view, which we mitigated towards our LPs with the closed fund structure.
Mm-hmm.
On top of that, we do invest in equity as well with the second fund, because the way you invest, the way you add value, the way you monetize such investments is completely different. Also, LPs that we're speaking to have different aspects as to why they would invest in this space. So it's a trade-off on many levels, but at the end of the day, we've separated the two. We have we see equal opportunities in both, which is why we're pursuing it. And which is why Blockwall is a platform to cater for both.
Okay. Eva, how about you guys at Arcane?
Yeah, so I think I'll probably be able to provide a kind of a nice counter to that, because we pretty much primarily focus on equity investments. Looking at two main focuses, one side crypto adoption, on the other side global payments. So we have a portfolio of complementary companies that enable us to think bigger in terms of the cryptocurrency ecosystem. We're focused on scalable solutions and in particular mostly around Bitcoin, which we feel that has the best infrastructure and liquidity at the moment. Generally, we have wholly owned subsidiaries, or we have a large investment in the company that kind of enables us to take an active role. But we recently made a small investment in a French company called LN Markets, which was a smaller amount, but it was for a company where we really thought that we could bring something more to the table other than just cash, and a really promising project we were interested in. In terms of the portfolio breakdown, we have Pure Markets, which is an interbank platform for tier 1 banks to trade crypto. We have Trio, a regulated retail exchange in Sweden. We have Alpha Plate, a high frequency trading and market making crypto company. We have Tesla Coil, which is a payments technology company with a Lightning network focus. We have Cryptograph and Arcane Media, which is our research team and separate media arm. And then we also have an asset management arm operating a crypto fund for accredited investors. And we recently entered into a share purchase agreement for the purchase of Kalpang, a locally regulated crypto broker in Norway. And yeah, that's the breakdown of our portfolio.
Fantastic. So, looking at the last, 12 months, we've seen quite a lot of change in the space. You mentioned a number of your portfolio companies are regulated, and so we've certainly seen regulators really come to the forefront in the last 12 to 18 months, putting in place governance and regulatory frameworks for companies to, adopt or adapt to. And just extending on what you've said about, the payment space, kind of the infrastructure space. What are your views on DeFi? And have you been participating in looking at DeFi technology or protocols that look to kind of disrupt that payment space that you've been operating in?
Yeah, I mean, we've definitely been taking interest in DeFi. I think everyone has. It is a very exciting kind of area of development, but we haven't been specifically looking at investing in, we haven't specifically invested in DeFi projects as of now. We've been looking more at second layer solutions on the Lightning Network. So I touched on LN Markets earlier in the small investment that we made there. They've recently launched a research paper to announce their LN Clear offering, which is a clearing platform to enable their participants to have direct ownership and access to their funds via the Lightning Network. So I think there's some synergies with the DeFi space there, and I think it's particularly interesting because it's looking to solve some of the same problems that DeFi is trying to address, or some DeFi projects are trying to address. So things like transparency and kind of having more self-custody, all of those areas are a focus for LN Markets, and just the general flexibility and simplicity around the platforms. In this setup, LN Markets is just acting as an escrow partner, so it's not a custodian. So they are the party that's enabling these peer-to-peer transactions to occur trustlessly. So I think that's probably the nearest we have in our portfolio for now. But obviously, we're always looking and exploring new projects, and it's definitely an area of interest.
Sure. And Lauren, how is Blockwall approaching the DeFi space, if at all? What's your view?
So as Eva rightly put it, you couldn't have missed it. As a fund, we have not invested in the most prominent DeFi projects, because conceptually it is absolutely interesting. But as a fund with a certain duration, I mean, we need to look at investments that are creating that, like, not sustainable, but plannable value over the remaining fund's duration. And DeFi seems still to be a bit of like a speedboat that's being built while it's operating at 300 kilometers an hour.
Sure.
And I mean, the holy grail to proper DeFi protocol solution adoption is to have mainstream non-crypto natives using it. Mm-hmm. And if you look around how difficult it still is for regular retail buyers to get their hands on Bitcoin, I mean, the stretch towards DeFi solutions is still a bit wider. So conceptually, we're having a close look on it, and we're seeing some of our investments like Ocean Protocol or Fetch that are data marketplaces. I mean, if you put the definition wide enough, it's DeFi, because you're monetizing data that hasn't been monetized before. But I mean, what most people would understand with DeFi is like stuff that's conceptually, as I said, very interesting, but for us, not yet investable as a fund.
Yeah, it'd be pretty difficult to explain where, the missing pickles went to some of your longer term investors.
So I'd have to write to investors. I will never want to write to investors.
So Laurenz, what are the other new verticals that you might be looking at that you might not have looked at a year or two ago?
Yeah, so I mean, what was most surprising to me is, and this is in particular with respect to our second fund that again is focused on early stage equity startups. Mm-hmm. I mean, the rate and the magnitude at which solutions are being built using blockchain is extraordinary. And I mean, why these equity investments is because they monetize on an equity level, and there's no token component that should be monetized at least. So what we're seeing is the rate of adoption that has begun, almost 18 months ago is absolutely incredible. And the area that we see with respect to that is almost exclusively on a B2B level. So we're seeing B2B processes being re-engineered, being made more efficient. And that's something that I could have only imagined when we raised the first fund that was supposed to invest in tokens that facilitate a certain use case. And now we're seeing these use cases being established. So this is like the rate of adoption, again, is what has surprised me on a positive note the most.
What about you, Eva? What are you guys looking at in the next trend of investments?
So we started out with kind of the trading and exchange infrastructure, and then we moved over into payments, looking for complementary companies that would work well together and that had a lot of synergies. I think that we've seen kind of more interest or more focus around payments the last year or so than we had at the start. But I think also our focus has shifted geographically rather than just on a particular project. So obviously we started out, as you would expect, with a Nordics focused, as we were Nordics investment company. But that has shifted now, and we now have investments in the UK and Sweden and France, and we're currently looking at potential partnerships or investments in US, Southeast Asia, and the rest of Europe. So I think that that kind of shows that that the exciting projects these days are not limited to one particular area, that it really is global in terms of companies building and working on interesting projects.
Mm-hmm. Yeah, I agree. So let's just circle back for a minute to the regulatory climate in Europe. So Blockwall sits under BaFin's jurisdiction. I believe Arcane has a NASDAQ listing. How has the regulatory environment either bolstered or hampered your investments business and maybe the projects that you would consider undertaking, either doing or not doing, because of the regulatory climate? And just looking across Europe with but the EU's MiCA regulations might affect your businesses and future investment strategies. Laurenz, let's start with you.
Sure. So, I mean, for us, we're more than happy with the domicile we have, because for us, it took a year to find the proper regulatory structure to set up such a fund that invests in token at the time. Today, it's much easier, but then we literally went on a treasure hunt around the world to find the best solution. And what it boils down to as a fund really is to have a regulatory and tax-wise stability, which is something we received in Germany. From an investments point of view, we can see that there's a lot of sandboxing going on when it comes to the establishment of token protocols and the monetization and the fundraising around that. But lately, it's been a lot more equity startups that we're seeing, and these typically didn't have that many regulatory issues when it comes to setting up shop. I mean, when you're talking about payment providers or settlement startups, they have certain money licenses that they need to have. But that's, I guess, true for any sort of startup in the field.
Okay, so let's just shift a little bit to kind of, sentiment around, what's happening across, venture capital over the last, 12 to 18 months or so. How's the profile of your LPs changed from when you started to today? Eva, let's start with you.
Yeah, I mean, so going from a family office to being listed, it obviously is changed quite a bit, or is about to change quite a bit when the process is complete. But I think in general, we've been seeing more interest for kind of the more traditional investors, your asset managers, your insurance companies. They're starting to take even more notice and saying, okay, how can I get involved? How can I get exposure? Whereas previously, it's something that they've had an interest in, but it's more from the the ventures, and they've sat on the sidelines and said, okay, well, I find this area interesting, but at the moment it's just not possible for me to allocate any funds to this area. So we've seen that. And
so
then,
would you say that the volatility of tokens has actually created a barrier or concern for those investors, or are you experiencing any kind of FOMO where people are jumping in that wouldn't have otherwise?
I mean, I would say for us that they view that as a completely separate market, and kind of that's more consumer face. So for them, unless it was, a setup where you have a token project that is being they have exposure to via a fund, for example, and that they're confident with the ability of that fund manager, then maybe they would be concerned with that side of things, or just pay more attention to it. But I think that the high volatility token projects that you're referring to don't really have any direct impact on our business and what our investors are seeing. They kind of view that as a side point and a meme that they'll look at on Twitter, but not really directly impacting their investment decisions. And most of the time, they trust, if they do invest via a fund, they'll trust the fund manager to know that these kind of fads or projects that maybe have less credibility are not something that we would necessarily be looking at.
Okay. And how about you, Laurenz? What's the sentiment from your side?
So there's definitely a huge difference that we could observe between the first fund and the second fund. So when we raised that first fund in 2017, our investors are exclusively single family offices and high net worth individuals that had the ticklish feelings beneath their fingernails and wanted to participate, but didn't really get their hands around it to do it themselves. And for that, we raised quite a significant amount of money, because we also had to learn at the time that a lot of what would be classified as proper institutional investors simply don't have a mandate to hold anything directly or indirectly that relates to tokens. So that's also what we see with respect to our second fund, the equity fund, where there's a lot of interest compared to the first one of people wanting to have access to this exposure to this still niche area of blockchain when it comes to venture capital, because they for themselves, and this is what COVID-19 has tremendously helped with, is they want to be invested in one of those exponential technologies that they've researched about and they want to have an allocation in. They don't see deal flow for that. They have a mandate to invest in venture funds, so that helps. So this is definitely what has changed. And on a side note, even though we're talking about an equity venture fund, the rising prices of token do support that to some extent, because it's an underlying confirmation of the technology overall, but it's not a major driver. But definitely when it comes to volatility, since you mentioned it, the fact that we have a closed fund structure is something that a lot of our LPs have come back to us saying, like, Laurenz, now I finally understand why I insisted on the closed fund structure, because I wouldn't have survived this roller coaster ever since.
Okay, that's very interesting. Yeah. So, looking ahead, both of you, what do you think the next big play is in the next 5 years that the rest of the market might not yet have its eye on? Lauren, start with you.
So, I mean, the major move I expect, aside from any predictions people have on price of Bitcoin or Ethereum, but I want to talk about the overall adoption of this technology, which I think is the more important aspect, is that, I mean, we're seeing, given our research institute, we see how many corporates have an active interest in this technology, and they're looking for solutions to adopt them. And on the other side, we see startups building those solutions. So to me, and there's certain industries that are just perfect to create first use cases, which is financial industry. So Eva's thesis is, in my point of view, spot on what they focus on. And there's also the whole industry around IoT sensors that's growing tremendously, that's looking for certain solutions that blockchain solutions can facilitate. So all around this upgrade on B2B software that we are seeing, I think is something that's getting more awareness over the next couple of years, where we'll see major growth on startup levels, very much adoption on corporate levels, and hopefully some exits as well, which helps the overall venture part around blockchain mature even more, because it simply creates more awareness. More awareness means more great minds that are dealing with it and more money that helps supporting it.
Brilliant. Eva, what about you? What's the next big thing that we're not yet focused on?
So, I mean, I'm not going to say not yet focused on, because I guess I would say that there is a ton of smart people out there, right? And our industry, compared to so many others, like everyone is constantly exploring new ideas and looking at new opportunities. So I'm not going to say that no one else is focused on it, but something that I think maybe we're focusing on, not that not everyone else is definitely Lightning transforming payments. So trading, gaming, all of those areas. And then Bitcoin for cross-border payments, so completely disrupting the global payments market. And then also the banks coming to crypto. I mean, I know we've been talking about institutions are coming for what feels like forever now, but I think that, you know, what we're going to see very soon is not institutions coming, but tier one banks, which is something completely different, and they'll also need infrastructure around them and the way they operate. So, you know, for example, what a tier one bank needs in comparison to what a hedge fund or an asset manager needs is very different, and they're very specific around what they need and what they want to be able to trade crypto. So I think that the service providers that can provide everything around trading and AML and data specifically for the big banks and their requirements, very, very specific requirements, I think that's also going to be very big.
Fantastic. I tend to agree with you, for what it's worth. Well, both, thank you so much for joining me today. I've enjoyed speaking with you both, and we'll have you back in a couple months and catch up with what you guys are up to next.
Sounds great.
Teana.
Thank you so much for having us.
It's a pleasure. Thank you. The success this year of DeFi platforms such as Aave have proven the demand for decentralized money markets and yield-generating opportunities. But as the industry matures and looks to scale, these networks will need to overcome challenges if broader institutional adoption is to follow. To find out what they are and how they might be resolved, Alex Batlin spoke with Aave's founder, Stani Kulichov, and James Kilroe, co-founder at crypto hedge fund Tendex, to hear how it might all play out.
Hi everyone, and thank you so much, Teana. So for the next segment, we're talking about money markets and DeFi. You're joined here by Alex Batlin, hi, me, and we have two really, really interesting guests with us. We have James from Tendex and Stani from Aave. Stani, hi Stani, give us a brief overview, please, sir.
Hey Alex, so I'm Stani Kulichov, the founder and CEO of Aave. So basically the Aave team contributes building the decentralized Aave protocol. That is essentially a money market where you can deposit cryptographic assets into the protocol and earn interest. And also a credit line is granted to borrow against other assets. And I started building DeFi when it wasn't really called DeFi, but just so-called dApps, decentralized applications back in 2016, 17. And we launched the first lending protocol in Ethereum, and Aave is practically evolvement of that. And before that, I basically used to work in legal industry. So my background is in law. And before that, I built Web2 financial applications. So this has been a pretty exciting time for me to build something like this, given that DeFi is kind of like smart contracts talking to each other, and this new kind of internet in finance.
So we created Tendex. It launched in Jan. It's a systematic market neutral fund. So we trade a whole lot of algorithmic systematic strategies, mainly across, almost actually completely across CeFi at the moment. And I guess my personal interest was I sort of fell in the blockchain space in 2015, 2016. I've been involved in designing some sort of different token economies, Civic, which was one of the sort of earlier projects that launched. I sort of helped redesign some of their token economics. I'm very interested in incentives. and how sort of technology and finance come together. I believe that DeFi offers a lot of very interesting potentials, and then obviously on a fund side for us, interesting arbitrage opportunities and other sort of opportunities to earn yield. Although there's still sort of a number of hurdles before, I think, big institutions. So this is sort of still very early stage, but exciting, and it's nice to be involved sort of at ground zero.
What I will do is I'll ask both James and Stanley the usual question I ask, which is why DeFi? So Stanley, love to hear more about Aave and why DeFi.
That's a cool question, because before I came to started to build applications on smart contracts, pretty much the deposits and lending facilities. Practically, I had actually a choice whether to build on smart contracts or just make the smart contracts surface small enough and do as much of off-chain execution as possible. And actually, when I was planning the actual business model, not the protocol itself. So I started from like a business model perspective, the thinking. Many of my closest kind of advisors and friends actually recommended that I should practically go with the centralized model, because that it's way more easier, and you could actually allow people to deposit fiat and also people can deposit crypto and borrow directly fiat and send from the banking system. But for me, like the properties of what smart contract based development provides, they're just so powerful, even without thinking the ecosystem. So let's say when you deposit to our protocol or are interacting with it any way, you practically see everything what's happening within the protocol. And this applies for the whole network. Let's say, for example, in Ethereum or something more straightforward like Bitcoin network. So you see all of the action that is happening. So you have practically transparent finance. So there is no black boxing in the sense that, let's say, how interest rates are decided, what kind of algorithms are used, are everyone paying equally in the same level from the interest rate or earning equally from that. So this transparency is very important factor. And also because smart contracts can be built in a way that they're hard to change. So basically immutability or governance, practically it ensures that transparency. And I think over time, what I realized that as the ecosystem started to grow more, that it wasn't only about basically the transparency or this functionality, but actually that you started to see other things being built in the DeFi sector or in on-chain ecosystem. So before Aave, there was decentralized exchanges, and particularly we saw automated market making protocols such as Uniswap and many other things. So you kind of started to see like an ecosystem where smart contract could talk to each other, and you as an end user, you practically have permissionless access to these facilities. So it actually doesn't matter anymore where part of the world you're accessing. You have the access to this kind of like an ocean of liquidity. And this is very fascinating to me.
James, why DeFi?
I guess that's a question I'm still trying to answer. I think there was a lot of hype and a lot of necessary hype, and excitement, and I think a lot of that came about through yield farming, and I think it brought a lot of speculators into the space. And like any sort of mania, there was a crazy period in June, July, August. And now I think people are busy trying to sort of work out in more detail that the exciting parts of it, that composability, etc., allows for more, perhaps potentially more financial innovation. As Stanley was saying, the idea that if you want to interact with the Stripe API, you need X permissions and agree to terms and services, etc. And the same with other policies and processes, slows down financial innovation to a degree, where here, as much as people can think of it, they can interact with it. The challenge with that is the risks that come about. So, the danger with these protocols isn't, of course, when you design a smart contract, that has obvious danger, but I think what people are struggling to grapple with is the complexity as these different protocols begin to interact with each other. And it appears to be that those failing points, whether it's an Oracle failure or through some sort of attack, is costing the space a lot of money. But I guess it's a messy way of finding the best solution.
So what kind of, in your your fund, you invest in the crypto space, kind of what, as a institutional player, effectively, what are your barriers? What are the concerns and the tensions you have to kind of adopting DeFi as part of your investment strategy?
So I think for us particularly, we're a market neutral fund, and we and so that it has one sort of potential element. But I think that there's a layer above, which is that with any money manager speaking more general, is that you have to be able to explain your risks to your LPs, because at the end of the day, this is you're a custody of someone else's money, and the people, the investors that have given you money, they've begun to appreciate and understand, at least, and believe that they can quantify, and that you have remedies for the risks around a centralized exchange getting hacked, or you can use multiple exchanges, etc., etc. The risks around smart contracts are still very, I guess, unknown to the let's say average person. And even explaining a smart contract to potential investors is quite complex. And then you layer on a level more, which is that this whole space is built effectively on a big part of it is built on the DAO. It's the DAI. If DAI had to fail through some sort of catastrophic failure, the whole space is quite vulnerable. And I think those, and I guess this kind of is the counterpoint to your build deep liquidity. I think in time that might be the case when people get really comfortable. But at the moment, they see these. What you see as one sort of pot of cash, other people see as a honeypot that is also a centralized point of failure.
That makes sense. We actually had, with the flurry of institutional interest in DeFi, given the market conditions, we've got a number of funds that we're working with. But the key ask has been a couple of times is, how can we prove that we have sufficient control over what we invest in, how? So, because take SushiSwap versus Uniswap, it would have been a bit kind of easy to get excited and move everything to SushiSwap and then kind of lose a lot of money. So we introduced the concept of DeFi firewalls, because we effectively support ability for folks to use your traditional MetaMask, but with our integration to safely transact with keys in our custody, but with the flexibility of MetaMask. But they wanted the ability to control which transactions are approved or not. So we've introduced the firewalls to do that. So that's been pretty popular. And it sounds like that level of control of which smart contracts are safe to use, which are not. You might also want to control which ones you use. Have you got Nexus Mutual Insurance for it or something like that, and so on. So there's sort of mitigation actions there. I guess, Stani, you've built a brilliant protocol. And I think probably, if I'm right, the first set of users were much more kind of retail end users, but it sounds like you're getting more institutional interest. I'd love to get your perspective on that side of it.
Yeah, I definitely think so as well, because I've seen DeFi in general being driven a bit of a retail interest in crypto in general for the past history. I've seen in DeFi also that there's interest from institutionals, and also I see kind of some of the retail segments are becoming more institutionalized. So practically it might be there might be some new functionality that becomes institutionalized, and one of the things are, for example, the liquidation networks on DeFi, let's say in Aave protocol, Maker. And these entities that are running these bots, they are becoming more professional. So that's interesting to see. And also some of the liquidity providers are becoming more professional as well. And in terms of institutional interest, there definitely is. I think for us, the kind of like biggest concerns are related towards the security, because not every DeFi is equally the same. As what we could say that not each cryptocurrency is equally the same technically, and other properties related to that. In that case, kind of like each DeFi protocol has its own kind of like complexity and also the way it has been built, risk assessment on different kinds of assets that the protocol has listed, and risk parameters. And I think this kind of like a safety is one of the things that institutions are eager to understand more, and basically what are the risks, because the interesting part is that all the data in DeFi and on blockchain is actually transparent and available, auditable by anyone, by institutions, by regulators, and there isn't just yet enough tools actually to quantify and basically analyze that risk.
Let's stop talking about barriers and let's start talking about something cool, which is, you got flash loans, rate switching, credit delegation. I'd love to know more a little bit about those things. What do they mean? Because I think this is the new stuff that actually you can only pretty much do on blockchain right now. I'd love to hear about those opportunities.
Yeah, definitely. So as the Aave protocol itself, what's interesting is it's always been about unlocking liquidity. So practically you might deposit one asset to an interest, but also you might borrow some stable coin, for example, and you have a long position in that deposit asset. So roughly 75% of the depositors, they're depositing into Aave, but they're not exercising their credit line, which practically means that there is roughly 1.5 billion worth of value in the smart contracts sitting there basically as a collateral. And what flash loans allows to do is to borrow all that liquidity in one single transaction and use that liquidity in one transaction on the Ethereum network. So it allows to do different kinds of functionality, such as arbitrage, for example, refinancing loans from one protocol to another, and swapping your collateral from one to another if you have a loan position, and various other things. So it's kind of like a way to get that liquidity into usage, and it generates also additional interest for the depositors who are providing that liquidity into the smart contracts. And I think flash loans is kind of like, we see flash loans quite often related to some sort of like a arbitrage exploits. And I think the issue is not flash loans per se, because it's usually the assumption of the protocol developers thinking that no one could have, let's say, 30 or 100 million worth of value, and they can come and just manipulate the market and use that manipulation and extract that kind of like a profit out of the market. When in fact, like when you're developing this protocol, you have to think that kind of like you can't make assumptions like this, and you have to kind of consider that there's infinite amount of liquidity when someone is interacting with these protocols, and they have to be resilient in flash loans. But in general, I think we have since January up to somewhere until November, early November, we have over 500 million worth of flash loans consumed from the Aave protocol, which shows that they're actually used in many other ways as well.
Just like an intra-block lending and borrowing.
Yes. It's kind of like, if you think about like some of the traditional finance, they might have settlements 1-2 days, or let's say end of the day. This settlement is practically on that block.
Yeah, that's one. Yeah, intra-block. Cool.
Yep.
But I suppose it doesn't sound as cool as Flash. So
Intra-block loan. How boring.
Cool.
I think the other thing that those might do, which is like maybe in sort of 5 or 10 years time, is that they provide the why do people raise funds to begin with? Well, you raise funds because you have a strategy, but you need obviously more capital to deploy it with. But a flash loan, if you people I haven't necessarily seen any of these, but if you could design strategies that run intra-block, you could effectively deploy the strategy and use the flash loan capital as your funds capital, and you wouldn't even launch a fund. It would be effectively a one-person team. And I know some people are doing that. Obviously, you were talking about arbitrage and also some exploiters. But it'll be interesting to see in time if people sort of professionalize around a small group of people that profit off using the flash loan liquidity as they effectively fund liquidity, because then you also only pay for it when you need it. Much like AWS, you only pay for your computing power as you need it. It's very interesting.
And interesting part is that kind of like, because you don't need kind of like you have the capital on demand, you basically pay on demand, so you don't need to have it upfront. And practically, if it comes to liquidations on MakerDAO system, the Aave system, or other protocols, it's difficult to compete with flash loans, because you get the liquidity, and it's up to then the kind of like a gas cost and so. So, yeah.
No, it's pretty exciting.
Interesting.
I guess maybe we finish off on yet another very exciting aspect, which is ETH2. It's around the corner. It's been around the corner for a long time. In fact, I think it's gone around every corner of a hexadecimal building, but it feels like it's right almost there. So I'd love your thoughts about, James, what does it mean? What does proof of stake mean? Yields on ETH2 versus ETH1. Love to kind of get your thoughts on this one.
Sure. I'm definitely not the technical expert, but I think that I think it's exciting. I know it's been around for a while. I think it will almost launch as the biggest proof of stake. I know maybe second biggest if you think Tezos, but it is. I think for me the more exciting element is what it enables. So it enables and hopefully transactions of sort of thousands a second. And as Sonny would know, we've built this whole ecosystem, or say we have this whole ecosystem's been built on Ethereum, and it's interoperable and it's brilliant. And the mind hive, or the hive mind that's sitting on the Solidity platform is huge. And one of the big sticklers is transaction costs. So I can't lease things for a second because transaction costs are too high. I know I sit on a board of a company called identity.com that's trying to provide digital identity, and they built out a whole system on Ethereum that's had to sort of stop for now, and are looking at potential other options. So ETH2 enables a whole sort of mirror of other opportunities and other sort of spaces like DeFi, other sort of specialities within crypto, and that's very exciting. In terms of the yields being different, I think that's just the market working out its terms of efficiency. There are obviously risks associated with it. You have to lock up and stake your capital for quite a while. That time has a cost, and also it may be indefinite if protocols but potential, given how long it's taken so far. I mean, these are very difficult problems, so I'm no way trivializing them, but of course those risks are those risks the market tries to factor in.
I guess if staking 2 is very popular, that dries up staking ETH supply in ETH1 and potentially kind of increase gas inflation so that's a bit of a concern for me. Any final thoughts on ETH2, Stani?
Yeah, I think interesting part is like how the ETH2 staking incentives will affect the DeFi yields, because they kind of are in parallel in the sense that there is demand to borrow ETH, let's say on DeFi, but when it's staking, practically there will be also more demand to borrow ETH. So interesting part will be kind of like what could be the arbitrage in between, because it might be that the lending deposit rate on DeFi on ETH might be practically something that is close to the ETH staking rate minus the kind of like operational cost and other indirect affected costs and risks, and that could be pretty interesting. And also secondly, some of the kind of like a staking as a service, and also this kind of like DAOs that are looking into partake into the staking, they're looking to basically tokenize those staking positions. And this is something that we're talking in Aave with other this kind of like service providers of them creating a actual money market for staked ETH, using it as a collateral to borrow liquidity from Aave. Those are kind of a couple of interesting aspects.
And that's also going to let the market trade on the sort of the progress of ETH2. You know, as we get closer, the price, assuming there's a discount between ETH2 and ETH, or maybe the other way. You know, but it allows sort of the market to trade in the frothiness of the process as well, which is quite exciting. I think overall it's going to be an interesting time, but I think it's also be very good for the space in the long run.
I would agree. And speaking of time, we're out of it. So thank you so much, Danny, and thank you very much, James. And I bid you farewell, and back to Teana. Thank you.
Thank you, everyone.
Thank you.
Thank you.
You've been watching Coinscrum Markets. Thanks for joining us, and please don't forget to subscribe to our channel. See you again next week.